there is always volatility involved in markets as well. And the market's job is to try and throw you off. Right now, generally speaking, most people have missed the massive rally in equities. And so they're hoping that the market comes lower. So we've seen that from the institutional surveys. People just haven't been involved. So a lot of it's been retail and passive money, index funds, stuff like that, without people actually making money from it. And that's always interesting to me because we come into year end and it tends to mean that somebody's going to have to make a decision how they want to report to their investors at the end of the year. And the pension funds and others don't want to show that they were massively underweight equities all year. But let's see how that plays out. I've got some strong views about the rest of this year as well.
This time, a crucial recession indicator isn't pointing toward an impending downturn, as indicated by Goldman Sachs. The yield curve inversion, typically viewed by investors as a harbinger of economic weakness, occurs when short-term treasury bonds yield more than long-term ones. This phenomenon can discourage banks, which profit from borrowing bonds at lower short-term rates and lending them at higher long-term rates, from lending. However, the global economy showed unexpected resilience in the first half of 2023. Nonetheless, the growth outlook remains fragile, with monetary policy becoming increasingly apparent, and China experiencing a recovery weaker than expected. Projections suggest that global growth in 2024 may be lower than in 2023. While headline inflation has been decreasing, core inflation remains persistent, mainly due to the services sector and relatively tight labor markets. There are ongoing risks, with the possibility of inflation persisting longer than anticipated, and potential disruptions in energy and food markets. A more pronounced slowdown in China could further weigh down global growth, and public debt remains high in many nations. Now, let's join Raoul as he delves into the dynamics of inflation and resistance, explaining why he maintains a positive outlook despite these challenges.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
You never trade today's news. You need to understand which part of the cycle is driving the asset prices and which part of the cycle is driving the Federal Reserve. So on this, myself and Julian Bittle, who works with me at Global Macro Investor, well, our job is to live as far out as possible. So we're in that 8 to 10 months area ahead where we're looking what's happening to the cycle. We actually go further out, but the bulk of our business cycle work, as opposed to our secular work, is this 8 to 10 months out. Now, the markets have been roughly trading 2 to 4 months ahead of the business cycle. In some cases, stuff like technology and crypto, they've actually been even further ahead than normal. And then we've got the central bank. Well, they're lagging with the ISM. If we take the ISM as where the economy is today, because it's basically a real-time GDP indicator, well, the central banks, well, they're looking for CPI to come down and unemployment. And those things are really lagged. In some cases, 6 to 8 months. And when we get down to the big inflation stuff like shelter inflation and wages, I mean, they can be over a year, sometimes 2 years lagged as that keeps changing. So, okay, that's now you understand where we are. So let's look at right now, the ISM. The ISM gives you the snapshot of where we are. And it's been around this kind of 46, 47 level for a while now. Now, that's a really important level because historically, that has pretty much had a 100% chance of recession. And I think most of us realize we've had a recession. I think most businesses have seen a slowdown. I think many people have laid off jobs, and we're seeing, and I'll come on to jobs later, a change in the job structure. But that recession has not been called yet. We've seen the economic data, the GDP data, still somewhat buoyant. But I think it's there, and I think when all is said and done, the recession will have been called during this year. But here's the rub. I think it's actually about to start becoming over. Now, again, I'm using the ISM. The ISM leads GDP because that's lagged by 3 months. So therefore, by the time the ISM gets positive, which I think is coming, and I'll show you that in a sec, that's all going to play out kind of Q1, Q4 to Q1. But the point being is we are at the trough of the actual cycle right now. So if we look at what we use as our main indicator, the GMI Financial Conditions Index, it has a 9-month lead. Now, this Financial Conditions Index is a blend of the dollar, commodity prices, and rates. Now, it led the whole cycle, suggested the ISM is going to recover. by a significant portion of time. It also gave us the trough 9 months prior. So we've known roughly when the ISM was going to trough from using our indicator a long time ago, and that what that was going to do to financial markets. You can see, interestingly now, it's rolling over somewhat. That's based on the fact that the dollar's gone up recently and rates went up recently. So it tells us something that we may see growth slow down or have a soft patch later in 2025. But anyway, let's not get ahead of ourselves. We're focusing on now, boom, bust. It's that crash, or are we in a next bull market idea that I want to go through.
Headline inflation has shown a consistent decline in many countries, primarily driven by the reduction in food and energy prices during the first half of 2023. However, when we examine core inflation, which excludes the volatile components of energy and food, it becomes evident that it hasn't experienced a significant slowdown. In fact, core inflation remains considerably higher than the targets set by central banks. A significant concern lies in the possibility that inflation may persist longer than initially anticipated. If this were the case, it would necessitate either further tightening of interest rates or maintaining higher rates for an extended period. According to Raoul, the concerns about an impending recession may have been overstated and might not be as severe as some people believe. He elaborates on his viewpoint as we proceed in the video.
We did have real inflation from the supply issues. They were real structural, well, not structural, cyclical things that were one-offs. And that's now unwinding. So one of the things that's really driving inflation, or the core inflation, the stickiness of core inflation, if you remember, when we look at those dominoes, the furthest domino back is shelter. Because shelter's incredibly lagging, even how it's calculated. So when we use the Case-Shiller Home Price Index, it's already unwound all of the inflation. It's at 0%. And that would suggest CPI shelter is also going to head down by 2025 to maybe 2%, maybe less. So this is yesterday's story, and this is going to continue to play out. And I think when the Fed get to cutting rates, they'll be cutting rates longer, as they always do after a recession, because the core lags the headline inflation, and they will focus on the core to get it down as low as possible. And before you know it, they overshoot. So they are going to be cutting rates as they see it coming down. Now, the other thing is wages. So wages have started deflating massively. Here's our wage growth tracker index at GMI. It's an 11-month lead, and the Atlanta Fed version, and it's just coming lower. So wages are coming down, rents are coming down, inflation, core inflation, because these are the stickiest parts, are going to keep coming down. So I don't know where this interest rate shock is going to come from. I understand there is a supply issue in rates right now, and that's probably keeping rates higher. I understand about the deficit. I understand about financing of rates, but we'll come on to that in a minute and how that's going to play out. So when I take out shelter from CPI, it already shows CPI at 1%. So the inflation story is over. Yes, commodities will rally somewhat at this point in the cycle, but to generate significant inflation, considering commodities are like 17% of CPI, you need a hell of a big move in commodities for it to even appear in this. And there's always a cyclical uptick in headline inflation before core inflation stops falling. Our view at GMI is we probably hit somewhere close to zero in headline inflation this year, and we probably hit zero or less in core next year. So therefore, we think that the central bank is going to be much more active than people anticipate. The other thing people talk about a lot is there's going to be a credit crunch and the market's going to crash. We've all seen the banking situation. I get it. There is a credit problem. And you see, if we look at bank lending year on year, it's starting to go lower. Of course it is, with that point of the cycle. But if we look at the lending standards, which leads it, it's already been pricing this in for a while now. And equities, I think, have already priced this in. Doesn't mean that bank lending's not going to slow down, but it means that the market's going to look through this, because what you find is bank lending standards is basically ISM. And if we think ISM is rising or starting to rise, well, then lending standards themselves will, and eventually bank lending itself will bottom out in a long time. So if bank lending is still contracting, but the economy is growing, the Fed will be more prone to action, continued action, when they start looking at these lagging things. Leads, lags, so important. Really, really important to understand.
The Organization for Economic Cooperation and Development has adjusted its global economic growth forecasts. In 2023, the OECD now predicts a 3% global economic growth, a 0.3-point increase from its earlier June forecast. However, there's a downward revision for 2024, with global GDP growth expected to be 2.7%. This change is attributed to increasing visibility in monetary policy and a weaker-than-expected recovery in China, potentially resulting in lower global growth in 2024 compared to the current year. The U.S. GDP is expected to grow by 2.2% in 2023, an upward revision of 0.6 points. But growth is anticipated to slow down to 1.3% in 2024 due to tightening financial conditions that could temper demand. China's growth forecast has been trimmed by 0.3 points to 5.1% in 2023 and by 0.5 points to 4.6% in 2024, primarily due to subdued domestic demand and challenges in property markets. In the Eurozone, GDP growth is projected to ease to 0.6% in 2023 but is set to rise to 1% in 2024 as the impact of high inflation on real incomes diminishes. The OECD report underscores the persistence of core inflation, driven by the services sector and tight labor markets. It raises questions about the government's response to these evolving economic conditions, inviting readers to share their thoughts in the comments section. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.